So back with another video. In this video, we are going to talk about monetary policy. How does it work? What are the main different effect or different type of qualities out there? Monetary policy is policy adopted by monetary authority of a nation to affect monetary and other financial condition to accomplish broader objective like high employment, price stability, normally interpreted as a low and stable rate of inflation. Further purpose of monetary policy may be to contribute economic stability to maintain predictable exchange rate with other. Today, most of the central bank and developed countries conduct their monetary policy with inflation targeting framework. Where the monetary policy, the most developing countries central bank targets some kind of the fixed exchange rate system. The modern monetary policy targeting monetary supply as widely followed during the 1980s. What has diminished in popularity since then, though it will still offer fairly strategy in number of emerging economies. The tool for monetary policy varies from central bank to central bank, depending on the country stage of development, institutional structure, traditional political system, interest rates targeting. Generally, the primary tool being obtained either directly by administratively changing the central bank on interest rate by indirectly by open market operation. Interest rate affect general economic activity, consequently employment and inflation via a number of different channels known as active monetary transmission mechanism, also an important determinant of exchange rate. Other policy tools include communication strategy like forward guidance and some countries on setting reserve requirement. Monetary policy is often referred as being a expansionary, stimulating economic activity and consequently employment and inflation. Contractionary, dampening economic activity, hence the decreasing employment and inflation. Monetary policy affect the economic through financial channel like interest rate, exchange rate, and prices of financial asset. This is contrast of physical policy, which relies on change on taxation and government spending on different method of government to manage wind cycle phenomena such as in developed countries. Moderate policy is generally formed separately by fiscal policy. Modern central bank in developed economies being independent or directly development or directives. How best can we conduct monetary policy? An active and debated research area drawing the field of the like monetary economies as well other field of macroeconomics, issuing coins and paper money. Monetary policy has evolved over the country along with the development of monetary economy. Historian, economists, and anthropologists of numismatic do not agree on the origin of money. In the West, common point of the view, the coin was just used ancient lied in the 18th century, 8th century BC, where some date of origin in ancient China. The earliest procedures of monetary policy seem to be debasement, where the government would melt coin down and mix them with cheaper metals, and practice with widespread in this late Roman Empire, but reached in the perfection in Western Europe in late Middle Ages. For many countries, centuries, there were only two forms of monetary policy: changing, altering coinage, or printing the paper money. Interest rate, while now though is a part of monetary authority, were no generally contradicted with other form of monetary policy during the time. Monetary policy is considered as the executive decision was generally implemented by the authority of is the power of coin. With the advent of the larger trading networking came to able to define the currency value in terms of the gold and silver. The price of the local currency in terms of the foreign currency, the official price, could be enforced by the law, even if the varied from the market price. Paper money originated from promissory notes termed as a GOG, the 17th century China. GOG did not replace metallic currencies used alongside used alongside the copper coin. The succeeding Yuan dynasty was the first government to use paper currency as a predominant circulating medium. In the latter course of the dynasty, facing massive shortage of space to fund war and maintain their rules to begin printing paper money without restriction, resulting in hyperinflation. Central bank and their gold standard. In the creation of Bank of England in 1694, with all granted authority to print note backward gold. Backend by the gold idea of monetary policy where independent executive action began to be established. The purpose of the monetary policy was to maintain the value of the coinage. Print note which would trade to especially the prevent coin from leaving circulation. The period of 1879 to 20, the industrialized nation established central banking system with one of the last wing of the federalism 1913. By the time of the role of the central bank, the lender of the last resort was established. It was increasingly understood that the interest rate has been effect on the entire economy in no small part because the appreciation of for the marginal revolution in economy which demonstrated that people would change their decision based on change of opportunity cost. The establishment of National Bank of Industrialization Nation was associated with the desire to maintain the country relationship of gold standard and trade to narrow currency when and gold vacant currency. To accomplish this, central bank as a part of the gold standard began setting the interest rate for that charge. The gold standard is a system by which the price of the national currency is fixed via the value of gold, and gold standard might be regarded as a special case of fixed exchange rate policy as a special type of commodity price. However, the policy required to maintain the gold standard might be harmful to employment and general economic activity by probably exacerbated the Great Depreciation in 1930s in many countries, leading eventually to demise of the gold standard and effort to create a more adequate monetary framework internationally. After World War II, nowadays the gold standard is no longer used by any country. Fixed exchange rate prevailing. In 1964, Bretton Woods system was established which created internationally monetary fund and introduced a fixed exchange rate system linking currencies most industrialization of US dollar, which has only currency in system which directly convertible to gold. Or during the following decade, the system secured a stable exchange rate internationally, but the system broke down 1970s when the dollar increasingly came to on overvalue. In 1971, dollar convertibly into gold was suspended. Attempt to revive the fixed exchange rate file. In 1970, major currency began to float against each other. In Europe, various attempts were made to establish regional fixed exchange system via a European world system, leading eventually economic and monetary unit of European Union and introduction of the currency euro. Money supply target. Monetarist economists long contended that the money supply growth could affect the macroeconomy. This included Milton Friedman, who early in the career advanced the government budget deficit during recession. We financially unequal amount of monetary creation to help stimulate aggregate demand for production. Later, he advocated simply increasing the monetary supply at low cost rate, constant rate at best, maintaining low inflation and stable production. During 1970s, inflation rose in many countries. Post 1970 energy crisis, the several central banks turned to be a money supply target and attempt to reduce inflation. However, when the U.S. Federal Reserve Chairman Paul Volcker tried this policy starting in October 1970, it was found impractical because of the unstable relationship between monetary aggregate and macroeconomics variables. Similar result prevailed in other countries. Even Milton Friedman later acknowledged that direct money supplying was less successful than he had hoped. How many minutes has been completed? Around 8 minutes has already completed. Inflation targeting. In 1990, New Zealand was the first country adopted the official inflation target basis of monetary policy. The idea is that central banks try to adjust interest rate in order to steer country inflation rate toward the official target indirect objective like exchange rate stability or money supply growth, the purpose of which was normally ultimately to obtain low and stable inflation. The strategy was generally considered to work well. The central bank is the most developed country have the years adopted similar strategy. A global financial crisis of 2000 sparked controversy over the use of flexibility inflation target employed. Many economists argued that the target inflation target decided upon were set too low many monetary regimes. During the crisis, many more inflation anchoring countries reached the lower bound to zero rates, resulting in inflation rate decreasing the almost zero or even deflation. In as of 2023, Central Bank of G7 members countries can be shared the following inflation target, including in European Central Bank and the Federal Reserve, who have adopted the main element of inflation target without officially calling themselves inflation target. In emerging countries, fixed exchange rate regime are still the most common monetary policy instrument, key interest rate. For the most central bank in advanced economies, the main monetary policy instrument is short-term interest rate. The for monetary policy framework operating under exchange rate anchor, adjusting interest rate together with direct intervention. Foreign exchange market, important tools to maintain a desired exchange rate for central bank target inflation, directly adjusting interest rate are crucial for monetary transmission mechanism which ultimately affect inflation. Changes in central bank policy rate normally affect the interest rate that bank and other lender charges on loans and free and household, which will then impact private investment and consumption. Interest rate changes also affect the asset price and stock price and house price, which again influence household consumption decision through a wall effect. Additionally, international interest rate differentiate affect exchange rate and consequently US export import consumption investment and export all the important component aggregate demand stimulating the suppressing the overall demand for goods and services in economy will tend to increase respectively diminish inflation. The concrete implementation mechanism used to adjust short-term interest rate differ from the central bank and central bank. The policy rate itself, the interest rate which uses to communicate its policy may be it either administrative rate or a market. How many minutes has been covered? All 11 minutes has been covered. By setting administrative rate at the commercial bank, possibly other financial institution which receive dispose in the central bank respectively pay for loans for central bank. The central bank monetary authority can create bank within which market interbank short-term interest rate will be typically moved depending on the specific detail. The resulting specific market interest rate may either be created or open market operation by central bank or in practice equal to administrative rate. As an example how this function, the Bank of Canada set of target overnight rate the board when the public minus 2.5 qualified bank borrow each other with bond but never above the below because central bank will always lend to them the top of band take deposit and bottom of the brand the principal capacity of borrow and the target rate of the generally short-term rate, the actually rate that borrow and lenders receive on the market will depend on the preserved credit risk, maturity, and other factor. For example, a central bank might to set a target lending 4.5 rather than open market operation. Through the open market operation, central bank may influence the level of interest rate, the exchange rate, and money supply of economy. Open market operation can influence interest rate by expanding and contracting the monetary base which consists of currency in circulation books reserve on deposit of central bank. Each time a central bank buys securities such as government bond or treasury will in fact create money, the central bank exchange money of security increase the monetary base while lowering the supply of the specific security. Conversely, selling the security of central bank reduce the monetary base. Open market operation usually take form of buying and selling security, temporary lending of money, collateral securities, foreign exchange operations such as foreign exchange swap. Forward guidance. Forward guidance communication practice where the central bank announces its forecast and future intention will influence market expectation of future level of interest rate and expectation for reserve requirement. Historically, bank reserve have formed the small action of deposits called fractional reserve banking. Over the time, the process has been regulated and ensured by the central bank, such as legal service required were introduced in 1990s in attempt to reduce the risk of bank exting themselves and suffering from bank rule, as this could lead to the knock-on effect and overextended bank. A number of central bank has been since abolished their reserve requirement over the last few decades, beginning with the Reserve Bank of New Zealand in 1985, continuing with Federal Reserve into 2020. For a perspective bank system, banking capital requirement provide a check on the growth of money supply. The People's Bank of China retain more power to our reserve because the yuan that manages its own convertible currency. Loan activity by bank plays a fundamental role in determining the money supply. The central bank money after aggregate physical cash which really used to wholesale financial market. Central bank money is really used to people the currency component of the money supply, credit guidance, exchange requirement, collateral policy, unconventional monetary policy at zero bound, helicopter money, national anchors, inflation targeting, fixed exchange rate targeting, money supply targeting, nominal income GDP targeting, price level targeting, nominal anchor and exchange rate credibility. The short-term effect of the monetary policy can be influenced by the degree of at which announcement of new policy declared credible. In particular, when anti-inflation policy announced by central bank and absence of credibility on the public inflationary expectation will not adopt, and short-term effect of the announcement of the subsequent anti-inflation policy is likely to be a combination of somewhat lower inflation, high employment. What if policy announcement is deemed credible? Inflationary expectation will drop commensurately with announced policy limit. Inflation is like come down with quickly and without so much cost in terms of the employment. Thus, there is an advantage having central bank of independent political authority. Still, to be formal perspective, But even the seemingly independent central bank whose hand are not said to be anti-inflation policy might to be deemed to not fully data context is used in developing countries. That's all for the video. We'll see you next time.